How does the property investment as an asset class compare to other investment options in terms of risk and return?
I think focusing on real estate, I think it's doubtless to say that, the brains here in the market, you probably are better analysts than I am. But just to focus on it as an asset class, which I think is still there's a case for investment in property. What I'm going to do is maybe give you a few useful information based on the Old Mutual, or at least privileged information, which I'll try to share. But based on the Old Mutual portfolio, the portfolio itself being probably the largest single entity owned property portfolio, we're talking of just over $500 million in terms of valuation, market value, that is for the portfolio itself. Close to 1 million square meters in terms of lettable space. So I think it's fairly representative of the Zimbabwean property market. But property itself as an asset class, just looking at the statistics over the last 5 years, whether you're looking at it globally and then coming to Zimbabwe itself, whether you're looking at it regionally and then coming to Zimbabwe itself, globally, property has been appreciating in terms of value. If you look at the specific markets, on average, statistics from OECD, that's an Organization for Economic Development and Cooperation. It's one of, it's a grouping of, about 30 or so economies. They show that on average, real estate has appreciated over the last 5 years by about 22%. And when you split it into specific markets, the appreciation is different and varied, but even higher, whether you take Europe, around 25%, you take America, it's around 30%. You take the emerging markets in which we fall in as Africa, we are somewhere there around, 30%. You come to Africa itself as a region, again, the trend is the same. Now, specific to Zimbabwe, where we don't have much of that information, because generally we don't like to share, but, borrowing from the Old Mutual portfolio itself, in local currency terms, we do track the portfolio itself in local currency terms for the past 5 years. That portfolio has performed in terms of capital return, and when we look at total return, that is your rental income and capital appreciation, it has actually appreciated and has performed above inflation for the past 5 years. 2022 and 2023 property, looking at our portfolio, it performed above the all share index. So it just gives you, a case for property as an asset class, just to see that, there is really a case to invest in there. Maybe for now I'll pause here, and then I'll share a bit more detail and a bit more twist to it. Thanks.
Oh, thank you. As well for the insights about our biggest property investor in Zimbabwe. And if their portfolio is gained by such a margin, it means there's scope for property investment. Moving on, my neighbor. What trends are you seeing in the property market in terms of demand, supply, and pricing?
Thank you very much, Doc. I think it will be prudent for me to give at least an overview in terms of the performance of the various use classes, because the performance is then shaping the trend and obviously the pricing. But I'll try to focus maybe on two aspects, namely the commercial side and the industrial side. So on the commercial side, when we look in the CBD, we have seen very high voids, especially within the office use class, voids of between 40 to 60%. And an interesting trend is that the voids are actually in the upper floors, especially of the high-rise building. And what we have seen landlords doing has been a repurposing or a shift in terms of the traditional uses of the spaces, So they've actually moved towards much smaller spaces, obviously to also accommodate the small and medium enterprises. But when we also look at the retail use within the CBD, we have seen a paradigm shift from the traditionally larger spaces to smaller cubicles. And I think I know of a case where one of the retailers has been actually chased or has had their lease terminated by the landlord to accommodate for repurposing of the space into, much smaller spaces. So the trend that we've seen is a movement or a preference towards much smaller spaces, which would obviously command higher rentals on the basis of the quantum reduction. So you find that for smaller spaces of below 50 square meters within the retail section, they're actually commanding about $50, an average of $50 or so per square meter. So what this has had, the overall effect is that even as REITs are coming into play, you also see that there might be also preferences by investors in REITs to also be inclined towards the much, bigger spaces, but partitioned or subdivided to accommodate, those smaller uses. But also an interesting trend, especially within the suburban, has been the development of retail shopping malls or complexes, especially along the strategic transport nodes. I think we've also seen Tigere coming in strong in that space by putting up quite a number of shopping malls. Then also coming back again, I think within the challenge of high void rates within the CBD, I think we've also had REIT coming also into that space, Revitas, in terms of identifying buildings with high voids and trying to repurpose those buildings to leverage on that opportunity. I think I'll pause for now, then allow the discussion to continue. Thank you.
Thank you. Interesting that we have the smaller spaces being preferred. So I'm just wondering what is happening to the bigger retailers. Is there scope for them? But anyway, we'll come back to that. Mr. Mende, I haven't forgotten you. Is your team ready?
Yep, the presentation is ready.
No.
Thank you, Mike. Good afternoon, everybody. We were asked to make like a presentation. So if you can bear with me, I'm going to take a little bit of time just walking you through this. My name is Chester Mende, which has been introduced earlier. I am with Shelter Incorporated. Our business is real estate. We are into housing, the living, through Shelter Zimbabwe, and housing in the afterlife, which is Etosha Gardens. We've been in this business for the last 43 years. What we are looking at is unlocking debt equity in housing. And our discussion is provoking debate on existing housing stock. We all know that Zimbabwe is awash with housing that are sprouting everywhere, and these houses are all being built for cash. And the obvious question that accompanies that is it wise that this should be the case? Shouldn't there be something done by the capital markets to unlock the cash that is sitting in all these houses? The next one is I'm talking about leveraging housing to promote savings it kind of sounds related to the first one, but slightly different. We are talking about new housing stock, and we are saying in an economy where savings is much needed, is there some kind of instrument that can be structured for promoting savings through housing? And we make an appeal or a suggestion that perhaps there is need to discuss resuscitating mortgage market. And finally, we see the real estate business is now anyone and everybody. We heard Mike talk of himself as a builder. I could do the same. I'm a builder. But we will find pension funds and banks have also become builders. And one is saying, what exactly is this industry about? Is there no benefits in focusing? So on debt equity, I have alluded to this, where we are saying what can we do there to unlock the value. I will not bore you with too much detail. We don't have a lot of time. I'm sure my slide will be shared. What we are suggesting as solutions is, according to the latest, monetary policy statement by the Reserve Bank, the loan deposit ratio in banking is at 49.27%. Financial institutions might want to lend out a little bit more. I was talking to a sister yesterday, and she, like many, are saying, cash flow, cash flow, cash flow. We are not bankers, or you will obviously understand better. We are simply provoking discussion on that. A few financial institutions which are offering mortgage finances might need to relax terms. Again, it's a provocation. We are not experts. Please don't throw stones at us. You will obviously know better. We are hoping that some of these provocations are material for food for thought. In a nutshell, we are proposing, various instruments like mortgages, home equity loans, and the like. On leveraging housing, again, I think I've talked about what this is all about. We are building houses at the moment, and we are saying, can we, see some activity by investors with some instrument that can exploit the opportunities in this area. We were talking to a financial organization not so long ago, and they were talking of an electronic, trading platform where you have the market coming in and out. Creating funds for building houses, and those that need to store their value, they'll come in, and those that need to come out for whatever reason, they'll trade out. But this again is something that is in the melting pot. Like I say, we have discussed it, and we have left it with those in the know to look at what they can do. But for us, we are saying there is stock. And we heard this morning about the accumulation from diaspora remittances in the amount of $3 billion. It's obviously what is sitting in this stock in these houses, and we are saying, how do we unlock that value so that it comes into production? Resuscitating mortgages. We are quite passionate about this because my company, which is a developer, has become a bank. we now have got a sizable portfolio where we are lending to people on terms. And it's not our business. We know nothing about this business. And all we are doing at the moment is we are saying we've got a data book, which other people would give it a better name and would do better with it. And we're saying, can something be done about that so that we can take our money and use it for something else? In our company, it might be small numbers, I don't know, but you're looking at anything between $5 and $10 million that we have, we're sitting on at any given time in our data book. And, you know, we can do more buildings with that $5-10 million if we had the cash. And here we have just made a few suggestions. There used to be the National Housing Guarantee. We've discussed this with the Public Services Commission. You know, there used to be the National Housing Guarantee Fund. We've discussed this with the Ministry of National Housing and Ministry of Local Government. And we're saying, you know, the capital market, can't you pick this up and revive these instruments so that we can get going somewhere? We haven't got the capacity to sit down with Public Services Commission and they arrange a $10 million facility for us so that we can build houses for civil servants. It can be better done by yourselves in this industry of the financing. I spoke about resuscitating mortgages. I won't go much into that. I think I've already said enough about it. Technology now is letting me down. Is there anything else? Okay. We spoke about core functionalities. I think each and every one of us in this room will know of a big brother that has gone into a housing estate and it has gone bad on them. And we are saying, should they continue to do that? Are they not wasting capital there? Are they not better off partnering with us? We like to think we know a thing or two about this, so that their money can be better spent. So we are encouraging the financial industry to exploit our core functionalities, we think, to the benefit of everybody in the market. I think I'll rest my case there, Mike. Thank you very much.
The attendees have acknowledged the level of sharing that you've done. We now know more about Shelter Afrique, but above that, Shelter Zimbabwe, rather. And you have given us insight into the residential sector, the non-availability of mortgages, which is quite a challenge, which is a huge opportunity for a mortgage REIT that could be formed. And we hope somewhere along the way, we have some who will come up with that structure for you, which would actually unlock value for you. But enough about the property market. Yes, Chester has shared about the residential. We have Stephen, who has shared about the real estate is an investment class, which is actually outperforming others. Then Darlington is shared about the commercial and industrial. I can't keep boring our attendees on the same subject, but now I'll go to the chairman's special invite. I invited Chenge as a special to assist and share with us what are EFTs and what are the benefits that. Let me just look at the question that I actually presented for you. What are the key benefits of EFTs compared to traditional mutual funds, and how are they transforming the investment landscape?
Thank you very much, Mike. I feel quite lonely up here. Nema Birida. Yeah, but I think, like Mike has said, I was invited to be part of this panel because if you look at the topic, it was talking about ETFs and REITs, but then I think the panelists realized that the panel was full of people probably with more knowledge regarding the real estate space. But you tend to understand why these two probably were combined, because ETFs and REITs were established almost under the same statutory instrument. They are both established under the CIS Act. So they are governed by the CIS Act, and they are both listed, which means they also report to the Zimbabwe Stock Exchange through the listing regulations. But just to give a brief background of what has really transpired regarding this market. So we had the first ETF on the 4th of January 2021, which was a top 10 ETF. Then later on, we had the next ETF coming on board January or February 2022, which was the Morgan & Co. Our financial sector ETF. Then later on in the year, mid-year, with the DATVEST. Then later on, Morgan again. And lastly, the Casado agriculture ETF. So we now have 5 ETFs on board. The benefits, now coming back to your question to say what are the benefits and how are they different from your mutual funds. So mutual funds, we are looking at your unity trust. There are so many similarities in terms of the establishment, in terms of the key players. There's a fund manager, there's a trustee. There are quite a lot of similarities. But the major difference is that ETFs are listed and unit trusts are not listed. That's where you have a difference. And then the second major difference is that ETFs are established under a certain theme, whereas unity trusts, you can buy and sell as and when you want. You don't really have to specify which kind of counters you want to buy. If you want to sell Barclays and replace Barclays with a counter in the agriculture sector, you can do that under unity trust. But in an ETF, you have to define your theme, and you have to define how you are going to be tracking that theme and what the underlying index will be. So those are some of the major departing points between your mutual funds and your ETFs. The transparency in terms of what you are holding also comes into play. Regarding the benefits for investing into ETFs, the most important benefit would be the issue of efficiency that it brings to especially your retail investors. Because if you're a retail investor, it's very difficult to sometimes diversify your portfolio. Because when you go to a broker will tell you that my minimum is probably $100 or maybe 100 shares or something like that. So if you have $100, it means you can only buy one stock. But with an ETF now, it enables you to get exposure to more than just one stock with the same $100, because you now buy units into a fund that is holding on to a number of stocks. So that's really the major benefit of ETFs, because that element of diversification. But then the other benefit, which unfortunately some of us who we have been passionate about ETFs have not seen that particular benefit come to fruition, is that ETFs, the most exciting part is to do with what we call in-kind creations and redemptions. That's really probably one of the most exciting parts of having ETFs on board. But unfortunately, it has not been really active. One, because I think it's an issue of liquidity. And also, so it has been liquidity on the part of turnover on the market, and liquidity also on the part of even the stocks that are being traded. So by in-kind redemptions and creations, you are now taking advantage of the mismatch between your unit price of the ETF and the NAV of the ETF. At any given time, you will find that those two will not be the same. So the good thing about ETFs is that even when the market is going down, it will give the market activity, because people will be trying to take advantage of that mismatch. And then if the NAV is low and your market value is up, you then play in the market to make sure so that the ETFs are created in such a way that it is a self-correcting mechanism. Over time, that NAV and the market value will come to very close to each other. But then as the market trades, you will find differences, and then people play that. But unfortunately, the activity there has been very low. We have been overseeing an ETF since 2021, but the number of creations and redemptions that we have seen, yeah, there have been quite a number, but not the kind of level and the kind of participation that we thought it would sort of create. Then even the brokers themselves, we didn't see the level of stampede that we expected in trying to register as market makers. So that has really been probably the downside in terms of the ETFs. But otherwise, generally, it's a product that has been accepted by the market, and also a product that we expect to grow. And lastly, Mike, one also other disappointing thing about ETFs so far is that if you look at all the 5 ETFs, the underlying instrument is the same. It's your listed equities. Whereas ETFs can be about anything. We can have a commodity-based, a bond-based ETF. There was also talk about an ESG-based ETF and things like that. So the unfortunate bit is that so far, all the 5 ETFs that we have on the market have the same underlying assets, whereas we would expect that ETFs should expand and then bring other instruments. There was talk about a bond market that is not developing. Probably as the bond market develops, we should also expect to see an ETFs that is combining quite a number of bonds and then listed probably on VFX, on ZSE, depends on where the bond market is going. But otherwise, I hope I have responded to your question, Mike.
Yeah, thank you so much. What I'm happy about is that you've actually shared opportunities that are available that I'm sure will benefit those who are attending. I've benefited a lot as well in getting the clarification of what an ETF is. But still with you, you're my favorite. How do ETFs impact market efficiency and liquidity? And what are the implications for investors? Just if you could share that with us, we'll surely make a decision to be investing in ETFs.
Yeah, so I touched on that a bit as I was explaining. I think probably my answer was a bit too long and winding. But when you look at liquidity, the liquidity comes in through all those. Because you find that our market is small, and the behavior of the market players is such that at one time there is so much excitement. The market is going up and everyone wants to buy. You have all these webinars going online. The Twitter, almost every day you have some space talking about ZSE and things like that. Then there's a time when the market is almost dead. Nothing is happening. So that's really where you need your ETFs to bring about that activity at any given time, because people will still take positions, taking advantage of the mismatches. And also looking at the liquidity. The impacts that the market liquidity will have on the development of ETFs is that when you are creating a basket, I talked about in-kind creations and redemptions. When you are creating a basket, you have to create the basket in the same ways as prescribed by that particular ETF. So if you have, like in the case of the top 10 ETF, if you have probably illiquid stocks like maybe your BAT or your CFI in that top 10, it then means that when someone is trying to do the in-kind creation, they won't be able to buy those stocks. And as long as you can't buy 1 or 2 stocks that are in the basket, then you can't deliver that basket to the fund manager. So in terms of the impact on liquidity, the impact on liquidity of ETFs also speaks to the level or the general level of liquidity of the market. But otherwise, ETFs in general, they are supposed to bring about excitement and then liquidity and to the market generally.
Yeah, okay. No, thanks, Yenge. You've done justice to my confidence in you articulating on ETFs. Now, before we start talking something else, do we have any questions?
Thank you. Thanks very much, Chester. Right, interesting. ETFs, REITs, any questions about this? It's getting to the end of the day, Mike. Eh? People are starting to. All right, guys. Okay, Mike, continue going, and then we'll see what happens. We have more. I've given you another 10 minutes, so go for it.
Just to share with you, thanks to our organizers, the Zim Ind, they actually gave me an opportunity to be sharing about REITs. So every Friday edition, you always find more about REITs. So take the opportunity, grab the previous papers, and read, understand more, and prepare your REITs along the way.
Yeah.
And
what I like about the REITs is that, as you know, Zimbabweans like two things. They like property and they like cars. I think above all things else. So at least a REIT allows you to invest in the underlying asset without having to own the individual stock, which is of course important because now you have a basket of assets which are in that sector which you can then invest in. So it's a very good product, and I think it speaks to what Justin and me we've been talking about for years. This is about how to stimulate retail investors. I think one of Justin's biggest KPIs, and it's up there for the last couple of years, is how can we move retail investors who are now at what, 0.00 something, right, on the market? What's the percentage of retail investors?
If you talk about the number of trades, probably about 10 to 15%.
10 to 15%. That's not bad, you see. So it's building up slowly. But if you look at other markets, of course, retail investors are a huge slice of it. And it's important to get retail investors, you and me basically, trading on the Zimbabwe Stock Exchange and the VFX, which of course is in US dollars. It's a perfect medium if we all have US dollars, as the minister says. Apart from me, of course, I have no US dollars. Right.
Yeah,
Mike?
Stephen, following your presentation about the real estate asset class, I want, if you can further explain what are the benefits and drawbacks of investing in REITs versus direct property investment?
So again, I think to a large extent you touched on that in terms of the benefits when you did your presentation, and Andy has just spoken about it, and I'm sure the brains here have a very good understanding of those benefits. I mean, the advantages and disadvantages. I could, there are several of them. I could just go to town. I could just pick one and go to town on it. I mean, like Andy, you've just spoken about the ability to, diversify and, have, without really investing directly in the underlying asset itself, because there are challenges that come with direct ownership of the actual asset itself. I could go to town on that alone. If you look at the current, you touched a little bit on it. If you look at the current setup of our legislation or the acts that govern real estate unfortunately transcends almost all aspects and all parts of people's lives. There are over hundreds in Zimbabwe alone. Unlike other jurisdictions, you would have what we call a consolidated act that governs real estate. You've got over 100 pieces of legislation in the form of either acts or statutory instrument that touch on the actual asset itself as a real estate asset. I don't think you want to be bogged down in all those administrative issues in owning that. A REIT gives you that advantage. You own the underlying asset, but you don't necessarily have the headaches of, all these other troubles of the laws that govern and the actual asset. You leave that to experts like myself and others in this room. So we manage that. You have things like your Road Act that touches on your real estate. You have the ZESA Act that touches on your, you have the Post and Telecoms Act, you have SIs on exchange, you have all this that touch on the, you leave those headaches to us. You just own, your asset through a REIT, which gives you that advantage. Obviously, there are others that I could speak about. Liquidity is another. Real estate is known to be an illiquid asset. This gives you the ability to, fairly comparatively more liquid asset. On the flip side, there are also other advantages for owning the actual asset itself. It's a tangible asset. We've heard of non-tangible assets dematerialized. I heard the term for the first time here. But real estate is a tangible asset for those that want to be very conservative. Zimbabweans are known, like Andy have just said, if you own your piece of property, the first thing that we do is put a boundary wall around it, just to emphasize the fact that it's mine, I own it. This is my place. This is so for those that are very conservative, you actually own that. It's a tangible asset. You have greater control of it in terms of what you would like. You can lease it. You can turn it into whatever you want. It's an asset. Unlike these other non-tangible assets, you own them on a piece of paper. I own a piece of paper that says I'm holding shares somewhere that are listed on the stock exchange that I probably don't have control in, as much control as I would like, maybe, in terms of what happens to the share price and things like that. Here is a piece of property. It's tangible. I own it. I can sort of determine within limits what I want for it in terms of the rent, the return that I want. So they're all varied. I could just go to town on any of the aspects that we touched on property. If I had more time, and if I wasn't abusing you after lunch, I would definitely have gone to town about it. Thank you.
Thank you, Stephen. You managed to take us to town. and thank you for taking us there. Now, Darlington, how do you think REITs can impact the property market in terms of liquidity and price discovery? How do you think the REITs can impact the property market in terms of liquidity and price discovery?
I think since the collective investment, we can have quite a number of even small players coming in to invest, and because the shares are, especially if it's a listed, REIT, the shares can actually be publicly traded, and in that, there is obviously price establishment, and analysts can easily infer on the pricing of the underlying asset. So it actually becomes easy because of that public trading. I think that's the long and short of it.
Thank you very much. I will still be on you, Darlington. Now, what role do you think REITs can play in attracting foreign investment into Zimbabwe property market?
So you find that I think I'll give a case in point of the Igu REIT. It is basically a development REIT, and in terms of its portfolio mix, it's actually a mixed use development REIT. So you find that in terms of the use classes, it is comprised of, it's inclined towards development of tourism stock. So there is a hotel, there is a hospital, and other residential units, and these are basically situated in Victoria Falls. And the intention is to then also list on the VFX. And in so doing, you also see that there is opportunity for foreign capital to also consider an investment in such a development because of, one, its location, the underlying assets being resilient, and also the target return being in foreign currency. So it actually provides a resilient, offering, also in the right color of money, which obviously the international community might be looking for.
Yes, interesting. Any parting shot, Chenge?
Actually, I just wanted to add on to what Darlington was talking about regarding
You have 90 seconds.
Yeah. So one thing I like about REITs is that I think as fund managers, one of the issues that we have been having problems with our biggest client, pension funds, is regarding the issue of valuation of properties. Sometimes we are accused of overvaluing property so that we collect higher management fees. So with the coming in of REITs, it gives you a market-determined valuation, because the REIT, the price of the unit is market determined. So when you now look at the total value of the property, it takes away the issue of subjectivity. Then the other issue, which is my last point regarding REITs, is that in terms of attracting capital, property is generally regarded as illiquid. So REITs bring about an exit mechanism, because they are listed. If someone brings in their money, they know that they can exit by just selling their units on the stock exchange, rather than owning a proper property. Because when you want to exit now, there are so many things that you have to go through that Stephen was talking about. But then when you are invested in a REIT, you are just selling your units on the exchange, and you take your money and you go. Otherwise, thank you very much, Mike, and thank you to the organizers for this platform. Thank you.
Thank you. Steve, any parting shots?
Not much. I think we've said pretty much the same.
45 seconds.
You've taken, yeah, but I think, Chenge, you've touched quite a bit on the points that I also wanted to just share. Of course, one of the maybe points that I would mention is the tax advantages. You spoke a bit about it, but I think in my previous life, that is in my previous work life before, one of the battles that was there was, this was a listed property company, and the challenge that we always used to have with, investors was they had to wait for us declaring a dividend, just like any other normal entity. And the clamor was always around, look, we are invested in property. We want to benefit directly from the rentals that are being generated from the underlying assets. And I think this is one of the things that REITs actually give you. You actually, you benefit directly from the rentals itself, the capital appreciation that is there, but also the tax advantage that comes with that distribution. If you have certain tax exemptions, you are benefiting. I know it's something that you're still working on and tweaking, but because as a REIT, you're having to just distribute the income, and the entity then benefits from whatever tax advantages it has. So I think that's also a major plus for REITs, and also that works positively for liquidity. Yeah.
Thank you, Steve. Chester?
Nothing much, Mike, except to thank the conveners for giving us this opportunity. I'm excited at the opportunity of coming in front of these capital market developers and speak to them as a builder and find out how we can convert bricklaying into money instruments that can participate in growing the economy. And thank you very much to the audience that has remained awake after lunch and at the tail end of 2 days. I was saying to my colleague, is there going to be anybody for our session? They will all have driven back to Harare. Thank you very much.
And interestingly, the house is still full. Everybody's awake.
Yes, very much so.
A round of applause to ourselves. Let's just clap hands for ourselves. We are doing well. Darlington, your parting shots?
Nothing much, but just to say that I think going forward, REITs will quite be, I think, an important vehicle in capital raising for major infrastructural projects. I think we should see more REITs coming on board, especially to fill in the gaps around housing and infrastructure. Thank you.
Thank you, Darlington. Thank you all for being with us up to this hour of the day after a 2-day session. And we look forward to more listings of REITs. We look forward to you investing in property. The experts are right in front of you who will do a very good job. And thanks to ZimInt for organizing, and ZSE, and also Security Exchange Commission. Thank you.